أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. Welcome back. If you're not speaking, I would ask you to turn the microphone off so that there is no echo. So our next set of items that we're going to discuss would be a classified balance sheet. Now, what do we mean when we say a classified balance sheet? As we discussed in our last session, the balance sheet represents the value of assets and liabilities and stockholders' equity at a particular point in time. So when I say balance sheet as of December 31st, cash 1 million, that means at the end of the day on December 31st, when the bank closed, the amount of money that the company had was 1 million. So all of these items in the balance sheet are for one particular point in time, and it's not for a period of time. Contrast that with income statement. When I say sales for 2020, I mean sales from January 1st through December 31st. So if I say 5 million, that means from January 1st all the way through the end of December 31st, in all of these 365 days, a total of 5 million was sold, right? But when I say balance sheet, cash 1 million, that means I had 1 million on that day of balance sheet, which is December 31st, let's say. Now, to understand the items in the balance sheet is broken down into further sections, and a particular type of items are recorded in each one of these sections. So let's discuss these items one at a time. We have assets on one side, and we have liabilities and stockholders' equity on the other side. And underneath assets, you see these the classifications: current assets, long-term investments, property, plant, and equipment, and intangible assets. On the other side, you have current liabilities, long-term liabilities, and stockholders' equity. We're going to discuss each one of these items, what they mean, how do we define each, and what are some examples of items recorded in each one of these subcategories of the balance sheet. So here is a balance sheet which is showing the current assets, the long-term investments, the property, plant, and equipment, and intangible assets. And on the other side, the balance sheet is showing liabilities and stockholders' equity. We have current liabilities, we have long-term liabilities, and we have stockholders' equity. You notice the total liabilities and stockholders' equity equals the total assets. So it is always the case. The total assets, 61,400, should equal the total liabilities and stockholders' equity. Now, I'm going to go back and forth. We start with the first item under the assets. If we go back, you will see the first category in the balance sheet is current assets. So let's go and see what do we mean by current assets. The asset the company expects to use within 1 year or one operating cycle, whichever is longer. Now, year, you know, what is an operating cycle? Operating cycle is the average time it takes from the purchase of inventory to the collection of cash from customers. So if it takes longer than 1 year, which is not the case for most companies, because if you buy fruits and vegetables, it will be sold within a few days. So it is not going to take more than 1 year. But in certain cases, it is possible that the company can hold certain assets and they would, you know, it would take more than 1 year to sell. For example, large items, let's say shipbuilders or companies such as that, they would make and build a ship. Maybe it would take them longer than 1 year in certain cases to build even the asset. In that case, the operating cycle is longer than the year. But the idea of current assets is that anything that you're going to use in a very short period of time, maximum of 1 year in most cases. For example, cash. So if you have cash, you can use that immediately. You have certain investments which you can sell and use anytime you like, so it can be done within 1 year. Receivables from customers, which are usually paid within less than 1 year. Inventories usually are sold within less than 1 year. And prepaid expenses usually are used within less than 1 year. What does prepaid expenses mean? You know, all of you have a personal prepaid expense, which is the insurance that you paid when you renewed your car tag. When you renewed your estimara, you paid for the insurance for the whole year. So this is an asset, and you use it over this period of time. So anytime you paid something for a whole year and you're using it gradually, this is called a prepaid expense, and this is a current asset. So all of these current assets are reported in the first part of the balance sheet. These are immediate assets that you can get benefit from immediately within less than a year. Is that clear? The concept of current assets. This is the first thing in the balance sheet. Yes, Mr. Muhammad, go ahead.
Doctor, regarding the example of the insurance.
Right.
The insurance is it's like, okay, it's going to be there is a continuous depreciation. It means it's not gonna be collected by the end of the year, or it cannot be converted to cash at any time. With the end of the year, it will be used totally.
Right. It's not necessarily conversion to cash. It is a benefit that you get. So for example, if you pay, for example, this company has prepaid insurance 400, that means anytime there is any need to use this insurance, either medical insurance or car insurance, you can get some benefit from that in case of an accident or sickness within that period of time. So it does not necessarily have to be converted into cash. It is converted into some benefit, and the benefit, if you did not get, you would otherwise have to pay cash for it from your pocket. For example, if you have health insurance, you go to the doctor. If you fall sick, you go to the doctor. You don't have to pay for that. If you didn't have the insurance, you would have to pay for the doctor's visit with cash, right? So you're not necessarily getting money from the insurance company, but because you have the insurance, you are keeping the cash that you would have paid if you didn't have the insurance. Does that make sense?
Yes, I saw the definition. It's cash or equivalent. I understand.
Right,
Thank
right.
you, doctor. Thank you.
No problem. But it is, I mean, at the end of the day, it is cash, right? Because it is cash or something that would require you to pay cash and you're not paying for it, right? It is, you're getting the benefit without paying for the benefit. Miss Ala?
Doctor, but still I didn't understand why we are adding it to the all assets, to the all current assets. If I am buying, if I am paying this amount of money, the $400,
Mm-hmm.
if I'm paying it, why am adding it to the assets?
You're paying this, it's an asset because an asset by definition is something that you can benefit from either now or in the future. So when you pay for this insurance, you're going to get the benefit of this coverage either now or in the future, which would save you from paying cash in case of an accident, right? So that's why it's an asset, because an asset is something that you can get future or present benefit from. Does that make sense?
Okay.
All right. Any other questions? Okay. So here, right, we looked at this list already. So let's go on to the next. We have the second category, which is long-term investments. Long-term investments are assets, but they are not converted into any benefit immediately. So for example, investment in stocks and bonds that you buy and you hold for a long period of time, right? And 2 years, 3 years, 4 years, 5 years, 10 years down the road, when you're going to sell it, it will give you maybe a gain, give you maybe more than what you paid for. So this is a long-term investment which you're going to get benefit from in the future, not immediately. Included in this are long-term assets such as lands or buildings that a company is not currently using in its operations. So let's say, excuse me, let's say you buy a piece of land and you keep and you wait for the price of the land to go up and you're going to sell it in the future. So this is a long-term asset that you're not using necessarily, but you're going to keep it for a future sale. And then a long-term notes receivable, that is, you may have lent somebody money and they're paying you this money over a number of years. So you're not going to get the entire money back in the next 12 months. It will take you 3, 4, 5 years to get the entire money back. It's a receivable from them. So it is coming to you slowly. You're not going to get the benefit of it immediately. So that's the long-term asset. That's a long-term investment. Moving along, the third category is property, plant, and equipment. These are assets that are used inside the operations of the business. So for example, you bought computers, or you bought machines, or you bought equipment to produce goods. These are long-term assets. They are used over a number of years. They include land, buildings, equipment, vehicles, furniture, etc. In the financial statement, there is an allowance for depreciation which shows the use of the asset, and it shows the net value after depreciation. So if you buy a building, it will be reported in the balance sheet for the original cost. But right below that, there would be a line with within brackets, within parentheses, that says accumulated depreciation, meaning you have used it for a period of time and it has depreciated in value. So the net value would be shown. So if you look at here, you have land, building, machinery, equipment, etc., etc. This is 2.2 million. And then 1 billion is accumulated depreciation, meaning this much has been depreciated. You have used it. So as you can see, almost half of the life of the asset is gone. So the historical cost or the purchase price was 2 million something, and the depreciation, accumulated depreciation, is 1 million something, meaning you have almost used half of the life of the assets, and now the net value is close to 1 million, a little bit less than 1 million, right? So the property, plant, and equipment continuously depreciates every year, right? Yes, Ms. Mariam.
Would it be safe to say that the value of the land goes down in terms of depreciation?
No, there is no depreciation for the land. The land does not depreciate. So there is no depreciation for the land. There is depreciation for the land improvements. There is depreciation for building. There is depreciation for other things. There is no, this depreciation that you see, it does not include any depreciation for the land. Okay?
Doctor, what do you specifically mean with land improvements?
Land improvements are, for example, parking lots, right? So you build a parking lot in the land, that is called land improvement.
Mhm.
Okay?
Okay. Okay.
It's not necessarily a building, but you maybe paved the road, or you made sidewalks, or you made parking, or you put some shades on the parking. Those are all land improvements. Ms. Sausan?
Doctor, can you please just explain the difference between the land that we mention under the long-term investments and the land we mention under the property? Like, how can we differentiate if we are adding to
Yes, the land
balance
under property, plant, and equipment is the land that is used in your operation. So let's say you have a factory, and underneath that factory there is a land that you purchase. So this is property, plant, and equipment land. And let's say you purchased a land somewhere outside the city, and it's just there, and you want to sell it in the future. You're just holding it, and it's not used. So this is called a long-term investment. Does that make sense?
Yes, very much. Thank you.
Okay, no problem. Okay, very good. All good questions. Moving along, the next category in the assets are intangible assets, which do not have any physical substance. So, for example, goodwills, patents, copyrights, trademarks, trade names, all of these things, they have some intangible value, but there is no physical asset to touch. For example, you write a book and it has copyrights. You have a new technology and you have a patent, right? And you pay for getting the patent, or you can buy the patent from somebody else. And just like the tangible assets, these have value. So let's say um, a pharmaceutical company comes up with a new medicine, and they have the patent for that 1 year. So no one else can produce that medicine for 1 year, right? So if they do, they have violated the patent, and it has a value. It has a market value. Although this is not something that you can physically touch, but these are intangible assets that are reported on the balance sheet. Does that make sense? Yes. Ms. Shaista, go ahead.
Doctor, what is goodwill asset?
Okay, goodwill, and we're going to discuss these again in future sessions in detail. Goodwill is something that you pay above the price of the physical assets. So, for example, let's say I open up a restaurant and I spend 100,000 riyals in buying the machine and the furniture and the uh, lighting and all of those things inside the restaurant, and I start operating. So I paid 100,000, and I operate the restaurant for 5 years. And if you look at my assets, if you look at my balance sheet, you will see I have almost depreciated 100,000. So the market value of the furniture and the assets would be, let's say, 20,000 riyals. But when I sell this business, I sell it for, let's say, 500,000 riyals. Why? Because I have an established business which you're buying, not my assets only. So this extra money that you're buying that you're paying to buy the business is called goodwill. Goodwill can only be purchased. It cannot be internally generated, right? So when you're buying a business and you're paying more than the physical assets, then your difference is the goodwill. Does that make sense?
Yes, doctor.
Okay, very good. And we're going to go into any further details. This is just an introduction. I think Miss Mariam had a hand up a minute ago.
Yeah, I just wanted to ask, for example, like a website domain, would that be considered an intangible asset? Because you're paying for that domain for a specific period of time.
Yes, it is. It is. But the thing with the domain is, it's complicated. The rules are complicated when it comes to the websites and so forth. For example, if you, let's say, And usually companies, if you ever uh, set up a website, if you would know that when you go to register, let's say you have a website called mariamalsulaiti.com, let's say, the company that will sell you that domain will say also register mariamalsulaiti.org, mariamalsulaiti.co, mariamalsulaiti.net, so that no one else can get this uh, website similar to your name and do misrepresentation. Do you follow?
Makes sense.
Right now, but the thing is, if you didn't do that, you just went and took mariamalsulaiti.com, and somebody else wants to spread bad name of your company or your individually, and they do something very close mariamalsulaiti.net, and they do misrepresentation, they uh, put misinformation, you could go to court with that. You could have a case. But again, these laws are very, very different in different countries and so forth. So it's complicated. It is sort of an intangible asset, but the laws are a little bit more complicated. And we will not get into all of that, inshallah, in this introductory course.
Okay,
Right?
thank you so much.
Okay, Ms. Safia, you have a question?
Yeah, I understood the meaning of the goodwill, but for example, if I bought a land which more than its actual, so how can I present it in the balance sheet? So I will divide the price into two parts. The price of for example, one will, for example, if it is 10 million, and it's the actual price is 2, so I'll put 2 million in the asset, in the price of the land, and the remaining in the goodwill, or
That is
how it
right.
can
That is exactly
be.
right. Whatever the actual value of the asset is, you would put that as an asset, and the difference would go into goodwill. So there is a complicated calculation for this, and one of the things that we used to do when one of our clients purchased a new asset, new business, is we would go through the valuation. It is called valuation. It's a complicated process, but what you said is exactly right. So let's say if we have paid 2 million and we figure out that the land is only 1 million and the building is only 1 million, and the extra 1 million is there, that entire thing would go to goodwill. Okay?
Okay. I have another question.
Go ahead.
What about the R&D? Is it considered as an intangible asset, or
Are all R&D are expensed?
it's
They don't
okay?
come into asset.
Okay.
Okay? Mr. Muhammad, you have a question?
Doctor, regarding the goodwills, the goodwill exists only in case of transferring the business from one owner to another owner.
That is correct. That is correct.
Establishing. So it's the reputation of the business.
This is the
Okay.
reputation of the business. It
Okay.
can only be put on the balance sheet when you sell it, and you cannot just add goodwill to your existing business.
Okay. Thank you.
Okay, very good. Moving along, the second category is current liabilities, which similarly to the current assets, these are obligations which have to be paid within 1 year or operating cycle. Same concept. In the current assets, we will benefit from it within 1 year. In the current liabilities, we are going to have to pay within 1 year. So let's say accounts payable, right? You have to pay the supplier within 1 year, maybe within 1 month. You have to pay the salaries of the employees every month, right? You have the wages, salaries and wages payable, which are going to be paid every notes payable, which could be due every month or every year, income taxes payable. So all of these things, right, are current liabilities. If you have a portion of a long-term loan that is due within the next year, then that would also be current liability. So let's say you have taken out 500,000 riyals in loan, 100,000 is due this year in the next 12 months, then that 100,000 would be reported under current liabilities, and the other 400,000 would be reported in the long-term liabilities. So that portion is called the current maturities of long-term obligations, right? That part of the long-term debt, the long-term loan that is due in 1 year, is called the current maturities of long-term obligations. Does that make sense?
Doctor, could you repeat the last portion again?
Yes. So let's take a look at it here. You see there is a line here that says current maturities of long-term debt. See this 57,250. This amount is due within 1 year, but the entire loan may have been definitely is much more than that, right? So there is a long-term loan. Of that loan, 57,250 has to be paid this next year, right? So this has to be reported under current liabilities because it's due within 1 year. Make sense? Okay, very good. Yes, Mr. Muhammad, go ahead.
It means currently we have to pay 57,250.
In the
but
next,
the loan is bigger than the
that
amount
is right.
already. Okay.
That is right. This is due within 1 year. So this is
So
within
in
12
case
months.
in
Yeah.
case we find in current liabilities current maturity of long-term debt, it means we will find on long-term liabilities the rest of the amount.
That is exactly right. Very good. Excellent. That is correct. That is correct.
Okay. Thank you.
Excellent. Okay. All good questions. Any other questions? Okay. The long-term liabilities are those which are due beyond the 1 year. So you have long-term debt, you have deferred income taxes, you have other non-current liabilities. All of these we'll discuss later, but these are things that are not due within the next 12 months. Bonds payable, mortgages payable, long-term notes payable, lease liabilities, pension liabilities, right? Pension liabilities, for example, are not going to be paid until the employees who will get the pension retire. So it is long term. So these are liabilities or debts that are paid beyond the 1 year from the balance sheet. And in the last portion of the balance sheet is stockholders' equity, which is common stock and retained earnings. Common stock, you can understand the stocks that are sold to the stockholders. Retained earnings, we have a whole statement. Remember, we have beginning retained earnings plus income or minus loss minus dividends, right? So retained earnings are earnings that the company has made from the beginning until now and has not paid out in dividends, right? So the total earnings minus the dividends that are paid out is reported in this line, and there is a total whole statement which you have looked at, and if you did the exercise, you prepared one as well, right? Make sense? Are you with me? Okay, excellent. Very good. All right, now let's do this quickly. If you can classify the following, we'll take turns. We'll start with Mr. Adil. Salaries and wages payable. How do you classify that? Where would you put it? And the classifications are given up here. So where would you put the salaries and wages payable? Mr. Adil?
In current liabilities.
Current liabilities. Very good. Ms. Ala, accounts receivable. Where would you put it?
Account receivable, the money that I will receive in short period of time.
Yes.
It is current assets.
Current
Okay.
assets. Very good. Did you have another question? I saw your hand raised.
No.
Okay.
I wanted to
Miss
add that.
Mai. Okay, thank you. Rent payable, where would you put it?
Current liabilities.
Current liabilities, excellent. Goodwill, Miss Mariam, where would you put it?
Intangible assets.
Excellent. Prepaid rent, Mr. Muhammad, where would you put it? Prepaid rent.
Prepaid rent is a current asset.
Current assets, very good. Miss Safia, where would you put mortgage payable? Miss Safia,
Yes.
where would you
Uh,
put mortgage payable due in 3 years?
Maybe long-term investment.
Long
No.
term? Long term?
Yeah.
Long
No.
term? Long term what?
And investment. No.
Your long term part is correct.
Liability.
Liabilities, very good. Long term liabilities, excellent. Ms. Shaista, investment in real estate.
It would be long-term investment.
Long term investment, very good. Ms. Sausan, equipment.
Property, plant, and equipment.
Excellent. We'll go back to Mr. Adel. Accumulated depreciation, where would that be?
In accumulated depreciation will be in current asset.
Try again.
Okay. Mm. Intangible asset.
No, it would be in property, plant, and equipment, right? Because the accumulated depreciation is shown right below the buildings and the machines and so forth, right?
Okay.
All right.
Fine.
Debt investments, Ms. Ala, debt investments, where would it be?
Current liabilities.
Current
Short.
liabilities, because it says short term. Very good. Ms. Mai, retained earnings,
Stockholders equity.
stockholders' equity. Very good. Now, a tough one for Miss Mariam. Unearned revenue. Let me see if you can do this.
Would it go into current assets?
Unearned revenue is
It would
going
be
to.
accounts receivable, wouldn't it be?
No,
No. I think it's current liability.
it is going to be
No.
current liabilities. Who said current liabilities?
So, yeah, I think.
So, yeah.
Current liabilities is the right place. Why? Because you have taken the
Yes.
money and now you have to perform the service. So unearned service revenue means
Yes.
you have taken the money. So for example, we have unearned revenue from the students who paid the tuition. Now we have to give them the lectures, right? And this is the current liability. It's not necessarily always money, right? It is something that you have to do, some cost you have to give up. For example, we're spending time and energy now to deliver the classes. We've already taken the tuition fees from the students, right? So unearned service revenue is a current liability. All right?
Yeah, makes sense.
Okay. Yes, Mr. Muhammad, go ahead.
Doctor, next to the account receivable. The accounts receivable, no idea about the time. Is it short? We receive it in short term or
Accounts
long?
receivable is always in current assets. It is not going to be called accounts receivable unless it is due right away. It will be called notes receivable if it is long term. The name accounts receivable by itself, it tells you that it is due, right? You have performed some service and the customer is supposed to pay you.
Also,
Okay.
the bond, there is a bond receivable, doctor. It will be
So
assumed like the note receivable.
right, the bonds receivable, notes receivable, by definition, those are long term.
Okay.
Right? Accounts receivable, when you see the word accounts receivable, this is something that is due to you very, very, very soon. Accounts payable is something that you have to pay very, very soon. It is not something that can wait for a long period of time. By the name accounts receivable and accounts payable, it's immediate. Okay? This sounds
Okay.
Yes, doctor, because I was preparing for the class. So the answers in the slides regarding the account receivable and prepaid rent, it's mentioned as NA. So can you please just tell me, tell us like if this is a mistake, or because in the slides, you got my point.
okay. It says what? Accounts receivable and prepaid rent. It says NA.
Yes, in the solution. So
And this is wrong.
okay.
That is wrong. Where do you see that?
Well, if because I was reading as a slideshow, right? The presentation. So there are when you click next, the solution appears for each one. So I can just send you if you want a screenshot.
No, it's okay. It's okay. As you see here, accounts receivable is in current assets. Then the thing is incorrect, or it's misplaced, or the slide is showing solution from another slide. In any case, current assets, accounts receivable are current assets, as you see here, right?
Yes.
And then prepaid expenses, right? Prepaid expenses, which is prepaid rent, is a prepaid expense. They're all current assets,
Yeah.
right? Okay.
Yes. I'm totally convinced with this. I'm just making a note that in the solution.
Right. If it shows up, I'm not seeing it in the slideshow myself, but if it's showing up in your case, then that is not correct. Okay. All right. Now we have the next section, which is the ratio analysis. So should we take a short break, or should we continue and finish a little bit early? It's your choice.
For me, it's fine to continue.
Yeah, finish. We can finish it a bit early.
Yeah,
if
it's fine for me as
possible
well.
for everyone.
Okay. All right. So let's continue. It's not the information is not that dry, so it will inshallah go quickly. Ratio analysis are relationships between different aspects of financial statements that give you some mathematical depiction of certain conditions, certain meaningful conditions of the company, right? So let's jump into it. The ratios are three different types. You have profitability ratios, liquidity ratios, and solvency ratios. The profitability ratios, they measure the income or operating success for a period of time. So when you're looking at profitability ratios, we're going to get into these ratios, how to calculate and what they mean. Generally, the profitability ratios show the income or operating success for a period of time. The liquidity ratios show the short-term ability to pay maturing obligations and meet unexpected cash needs. So liquidity means, you have heard this term probably before, the most liquid asset is cash. You can pay for anything with cash. Anybody would accept cash. So the most liquid asset is cash, and the more cash you have, the more liquid your company is, the easier you can pay your obligations when they come due, right? This is called liquidity. Solvency means the ability to survive over a long period of time. So solvency means that you have enough assets compared to your liabilities, your obligations, that you'll be able to continue operating your business and survive for a long period of time, right? And each one of these categories have different calculations and ratios that we're going to look at. We're going to use the financial statements to extract some numbers from the financial statements and calculate these ratios, and then we're going to discuss what they mean. Okay, so here we have the first one. It's earnings per share, right? What is earnings per share? We want to know we have the income for the entire company, and we have certain stocks, number of stocks that the people have from that company. We want to know how much is the income for each one of these stocks. So you can multiply the earnings per share, and however many stocks you have, you can multiply that with the earnings per share, and you would see your portion of the company's earning is that amount. So how is this calculated? The formula to calculate this is you take the net income and you subtract the preferred dividends. Now, there are two different types of stocks in many companies. One is the common stock, and the other one is the preferred stocks. The preferred stockholders get something called a preferred dividend, which means that the dividends would be paid out to the preferred stockholders first, and in some cases they're guaranteed even if the common stockholders do not get any dividends. And there are a lot of other things associated with this. We don't want to get into too much in too much detail, but suffice to know that preferred dividends are those dividends that are given to preferred stockholders, and they may be paid when common stockholders are not paid anything. So to calculate the earnings per share, the preferred dividends are subtracted, because this is something that is guaranteed to be paid in many cases. So we have the net income of the company minus the preferred dividends, and then it is divided by the average common shares outstanding. The calculation for average common share outstanding is by taking the beginning balance of the common shares and the ending balance of the common shares and taking the average. So you have 393 plus 419 divided by 2, right? And then you have the net income minus the preferred dividend for 2011, and it's $3.14 per share. So if you had 100 shares of this company, your portion of the earning of that company is 3.14 times 100. This does not necessarily mean the company will pay you this money. The company will not pay you, but this shows the earning for each stock that is owned by the stockholders, right? So you can say this is your portion of the earnings if you hold one stock, and you can multiply that with the number of stocks. Does that make sense?
It does, doctor, but what is the preferred dividends over here exactly?
Preferred dividends, there are two types of stocks, common stocks and preferred stocks. Preferred stocks are sold at certain prices under certain conditions that are different from the common stocks. And the preferred stocks come with certain benefits and certain restrictions. So for example, let's say the company needed money to fund a new operation. The company would issue some preferred stocks, and they would say, this is the price of the preferred stocks. If you want to buy, there is a guaranteed dividend at the end of the year of X dollars, but you would not have any voting rights. So when the common stockholders vote for who the president of the company is going to be, you're not going to be one of those people who will get to vote. These preferred stockholders have some type of guarantee of the dividend regardless of the company's financial performance. That's why these preferred dividends, which are guaranteed, are subtracted from the net income, because in many cases the company's cannot decide to give or withhold. They have to pay. So that's why this is subtracted from the net income before calculating the earnings per share for the common stockholders.
Okay, I get it.
Okay,
Yeah, thank you.
you're welcome. Miss Ala? Miss Ala, go ahead.
Doctor, I didn't get it very well. This earning per share, you mean that because this is we are talking about the profitability ratio, yeah? So the
Yes.
earning per share is it the money that the company gain when they issue stocks and shares?
No, no, no.
Uh-huh.
This money that you have here, net income, this comes from which statement? This net income comes from which statement? Tell me.
Not the balance sheet.
Income statement.
It comes from income statement. Revenues minus expenses is net income, right?
Yeah.
Okay. So let's take a look at it this way. Let's say you and Ms. Shaista, you open a business and you have 100,000 riyals in sales and you have 50,000 riyals in expenses, right? And your net income then would be 50,000, right? 100,000 minus 50,000. Your net income would be 50,000.
Yeah.
If you have only two shareholders and you have two stocks, then your share of that earning is 25,000 and Ms. Shai's share is 25,000. So earnings per share is divided by 2 because there are only two shares. You follow?
Yeah.
Similarly, the number of stockholders that are there in the company, in a publicly traded company, are in hundreds. So to calculate the earning per share for each stockholder, this calculation is done. Does that make sense?
Yes.
Okay. Very good. Now, we move along. This is the statement of stockholders' equity. The next ratio that we're going to calculate, we go back here. Before we go there, look at this particular statement of stockholders' equity. Here, we have the balance of the common stock at the beginning, and we have the balance of the common stock in the end, right? And we have a few observations from this particular statement of stockholders' equity, and they are: number one, common stock increase in the first year as a result of issuance of shares. So you see here, the beginning common stock was 246, and then another 237 shares of stock was sold. So the end of 2009 or beginning of 2010, the balance of the common stock increased from the beginning until the end because more shares were issued. The common stock decreased during the second year because the company repurchased. So you can buy back, the company can buy back stocks from the shareholders. It issued 303, but it purchased back 729. So the balance at the end was 57. And this is in millions. All of these numbers are in millions. So it's 57 millions, right? This is just showing you the change of, this is not a ratio calculation. This slide is just showing you the increase and decrease in certain numbers. It also shows that Best Buy paid dividends each year. So here, you would see here, dividends were paid in 2010, and dividends were paid here in 2011. In both years, dividends were paid. And then for many years, Best Buy did not pay dividends, even though it was profitable and could do so. What this means is, when it comes to common stock dividends, the company can choose to pay the dividends if it wants to, and if it does not, it can withhold. Now, I have a message from Mr. Muhammad that he is unable to hear. Is that the case with all of you?
No, we can hear you.
We
Yeah,
can
we
hear
can hear. I can hear.
Occasionally your voice is dipping a bit, but then you're catching up.
Mr. Muhammad, can you hear me now? Okay, I'm going to continue because it will be recorded, so Mr. Muhammad can look at this, hear this portion, inshallah. Yes, Miss Mariam.
Doctor, I just had a question. I'm having trouble connecting between the retained earnings and the earnings per share.
Okay, the retained earnings is calculated with numbers in point in time. So you have the retained earnings, beginning retained earnings, which is all the earnings from the beginning of the company until 28th of February 2009, right? So that's the retained earning.
Yeah.
Earnings per share is the amount of earning for each share for a period of 1 year, right? So 3.14 means for each share of stock, the company made $3.14, right, during that year.
Okay.
Okay. Okay. Now we go into the next set of ratios based on the balance sheet. A liquidity ratio is, for example, the working capital. What is working capital? It is current assets minus current liabilities. Current assets are those things that you're going to either get benefit from right away or within 1 year. So cash and cash equivalents within 1 year. And current liabilities are those things that you have to pay within 1 year. So the difference between your current assets and your current liabilities is called the working capital. So the more current assets you have compared to your current liabilities, the more liquid you are. So let's just take a look at a very, very simple example. Let's say you have $1 million in accounts receivable and $700,000 in accounts payable. That means 1 million minus 700 is going to be your working capital, 300,000, right? So the larger this working capital is, the more you're able to pay for your desired expenses and obligations. Does that make sense? Working capital makes you more liquid. The more you have, the more liquid you are, the more flexible you are. Make sense? All right. Now, the liquidity ratio measures the short-term ability to pay maturing obligations to meet unexpected needs for cash. The current ratio is one more measurement of liquidity. Current assets divided by current liabilities. And obviously, the more current assets you have and the less current liabilities you have, the better your current ratio is, right? So if we put, the calculation is very simple. Uh, and this, because we are doing this in Blackboard, these numbers are not showing. If you plug in 2011's current assets here and you plug in the current liabilities here, you will see that the current liabilities, assets to current liabilities 2:1, meaning for every $2 of current assets, you have $1 of current liabilities. 2:1 means your current assets are twice as much as your current liabilities, right? Here, your current assets are a time and a half. So the larger the current assets are, the better your current ratio is, the better you're able to meet your obligations. Does that make sense? If your current liabilities are more, that means you have your company is in trouble because you're not going to be able to pay your current liabilities with your current assets. Does that make sense? It makes you less liquid. Okay, this third, yes, go ahead. Mr. Adel, you have a question?
Uh, like when you are splitting them, in this case, while I see in the slide, there is a particular amount given over there, and when you are dividing that amount, you get a specific ratio. So when you divide the amount, you will get a specific amount. So how do you have the ratio in this? Is it
The
always going to be one in this case?
yeah, in the right side, it is always going to be one, right?
So whatever
So
amount you get, that is going to be like how
right,
do
so we
you?
say is to one, right? So 1.18 is to one, 2.00 is to one. So it's always is to one. So the right side is always one, right?
Okay.
Okay. So it is how many more times the assets are, current assets are compared to your liabilities. So let's say you have 5 on top and 2.5 in the bottom. That means it is going to be twice. So 2 is to 1. If you have 20 on top, right, and 5 in the bottom, then it's going to be 4. That means 4 is to 1. It's 4 times more. You follow?
Yeah.
So
Doctor,
yes,
doctor, but if the liabilities is more than the assets, we will get it less than one, yeah? Like
that is
0.
correct. If the liabilities is more than the assets, the number is going to be a fraction. So it is going to be less than 1 is to 1. So it's going to be 0.5 is to 1 or 0.75 is to 1. That means for every dollar of liability you have only 75 cents in assets. You follow?
Yeah.
Mhm.
Right? It's going to be a fraction. The liability is always going to be 1, and then either the current asset side is more than 1 or less than 1. If it is less than 1, that means you're in trouble. If it's 1, that means you're barely making it, right?
It's
Make
okay.
sense?
Yes.
Okay. The next is solvency. So the solvency is the ability to make minimum loan payments as they come due and to repay the balance of a debt due as it matures, right? So the solvency ratios measure the ability of the company to survive over a long period of time. Let's take a look at a ratio. Debt to asset ratio, right? Debt to asset ratio. So total liabilities divided by total assets. Here, remember, this is long term, so we put the total liabilities. This is not just the current liabilities, but the total liabilities over total assets. And you see, uh, in the first case, it's 62% or 0.62, right? Which is a fraction, right? Which is a fraction. That means your liabilities are 62% of your assets. Your liabilities are 42% of your assets. Your liabilities in this third case is 57% of the assets, right? So here, the lower the number is, the lower the percentage is, that means you have more assets compared to your liabilities, right? So this is the total, all short and long-term assets combined together. The more total assets you have, the less percentage of your total liabilities are of your total assets, the better your position is, the more solvent you are, right? So again, if you ask, why is this not presented in the same way? Why don't we look at it in the 1.5 is to 1 or 2.5 is to 2? You could, but this is how the standard is. This is how people who came 100 years ago before us have decided to do it, and this is how the standard setters accept it. So this is what we follow. This is what we. You could look at it in the same way as you do the current assets. It would, and you could interpret it the same way. The bottom line is, the more assets you have compared to your liabilities, the better off you are, long term or short term, right? Does it make sense? It is common sense, right? It's common sense. If you have more assets compared to your liabilities, you're better off. Mr. Muhammad had a question.
Doctor, there is more than one solvency ratio. There is many solvency ratios, and the
Yes,
debt to
yes,
assets is one of them. We have to know
yes,
about one of them, I guess.
that is right.
Same for the liquidity one. Huh?
That is right. We are just
Okay.
beginning. There are a host of things that we're going to discuss that are coming. This is just an introduction,
Okay, thank you.
right? Other questions? Okay. So here, this slide is giving an example of the debt to asset ratios of different companies. As you can see, American Pharmaceutical Partners is 19%, General Motors 94%. That means almost all of their operation is finance, right? So their liabilities are 94% of their assets. And you can imagine that for General Motors, because they're heavily invested. They have a lot of liabilities which they use to finance their operations, right? Kodak, Sears Holding, as you see, these are large retailers and so forth. Sears is. So they have a lot of, they continuously turn around their inventory. So they have a lot of debt and payables due to different stakeholders, right? Microsoft, as you see, is only 21%. That means their assets, their liabilities are only 21% of the assets. Just some examples here. There is another measurement which is called the free cash flow, and it gives an idea of the company's ability to generate cash. And the way it's calculated is you take the cash provided by operations and you subtract capital expenditures and cash dividends. Now, this is immediate expenses that are coming due based from the cash that you have generated from your operations. So the cash provided from operations are coming from your buying and selling your goods and services that you're providing, minus any capital expenditures, meaning any equipment or any asset that you're going to buy, that you're going to spend money on immediately, and any cash dividends that you plan to pay. So the free cash flow shows how much money you would have after paying for these immediate items from your cash that is coming from operations, right? Yes, Mr. Muhammad, go ahead.
Doctor, there is cash flow coming from financing activities. It will not be counted.
For the free cash flow,
there is cash coming from financing activity.
Right. In the free cash flow calculation, that would not be coming from that would not be considered here in the free cash flow calculation, right?
Okay.
You see here we have three things: cash coming from the operating activities, cash going out in the investing activities, and cash going out in the financing activities, right? Why these two particular items? Because they are immediate payments that are due in the investment and in the financing activities. There are other items that are reported in the statement of cash flows which is not taken into consideration in the ratios. Remember, as you might have some idea from your questions, I understand that you have some idea about the ratios and so forth. The ratios by each one by themselves only give you a small view of a particular angle of the company. It is not comprehensive, right? Would you agree with that? The ratios do not by themselves, each one by themselves, does not give you a whole picture. You need to look at all the ratios and you need to look at the financial statements to get the whole picture. Each ratio measures something from a particular angle and something small, right? Ms. Sausan?
I just wanted to answer that. Yes, I agree with that. Thank you.
Okay, very good. Okay, so here again, it's an example. The cash provided by operating activities, $100,000, less expenditure on property, plant, and equipment. So this example, it says MPC produced and sold 1,000 personal computers this year. It reported $100,000 cash provided by operating activities. Okay. In order to maintain production at 10,000 computers, MPC invested 15,000 in equipment. It chose to pay 5,000 in dividends. Calculate free cash flow. So now here, this is a selected set of numbers from the entire set of financial statements that represents one particular thing about the company. That is, these the $100,000 that is coming, it is coming from the operating activities. The sales may have been more than 100,000, and there may be another 100 or 200,000 in accounts receivable. But it doesn't matter how much the sales was. It doesn't matter how much the accounts receivable is. It matters how much cash came in from the operating activities. So you're sitting in the shop and you're having customers come, and some of them are paying with cash, and some of them are paying with a debit card or a credit card. You're sitting inside the shop. The only thing that you have right now is the cash that the customers have given you. Are you following? You don't have the money paid with the credit or the debit card. It will come eventually, but you're sitting at the shop. The money in hand is money that you have already received, right? So this is money at hand. Then you have to pay for something that you need to continue your business, right? So let's say you need to buy uh, a chair or a table or something that to continue your shop, you need to buy that. You have to pay for that from what money? The money that you have already, not the money that you will get later. It doesn't matter what you will get later. This is something you have to pay for now. So what you have is what matters. So you pay for that, and then you also have decided to pay 5,000 to your stockholders. Again, what you're going to get in the future, it is not with you right now. It is in the future. So after paying for what you have to buy right now, and after paying your shareholders what you need to pay right now, the leftover money is the free cash flow that you have, which you can use right now for anything else you need. The accounts receivable will come, the other money will come, but this is what you have right now with you. Does that make sense?
Yes.
Okay.
Yes.
So as they say, cash is what? Do you know?
Yes.
What
So
is
over
cash?
here, doctor, so over here, like as you have mentioned, the total amount that is paid for the operation is 100,000.
The money collected from the operations is 100,000.
Yes, is 100,000. So over here, you're paying an expenditure for the property and other things. It's 15,000, and for the free for the other activities, you are paying 5,000. So,
Dividend.
oh, yeah. So basically, like this is the 5,000 that you're paying is for the operation. So, like for things to run in the flow.
The 5,000 you're paying to the shareholders. Dividend,
Shareholders.
right?
Yeah. So
So this is
at
not
the
for
end,
running operation.
okay. So at the end, you're having this much amount.
Right. So you see the wording, it says it chose to pay 5,000 in dividends, right? Chose
Yeah.
to pay meanings the company decided to pay the shareholders dividends. Dividends do not have to be paid in most cases. The company decides to pay. The company chooses to pay, right? So
Hmm.
once it declares that it's going to pay that, you have to pay. And then after that, whatever is left is the free cash flow.
Okay.
Right. So I had typed in here cash is dot 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 question mark, and Ms. Shai says asset. There is something else that is uh, suitable for that blank. Anybody knows? Anybody heard this expression? No. Cash is king. Okay. That's what they say. Cash is king because you can do anything you like with cash. Right. You can do
Yeah.
anything you like with cash. Mr. Muhammad.
Yes, just can you go back a little bit to the statement of stockholders' equity and equity? The other adjustments is the slide after the earning per share.
Yes.
Other adjustment definition.
Right. So there is a lot of things. There could be a number of different things in the other adjustments. For example, sometimes I'll give you an example, and we cannot do a comprehensive discussion because it requires a lot of other definitions and understandings. But just quickly, it could be something that was incorrectly reported in income in a previous year and it is adjusted here. So it could be other adjustment could include prior period adjustments, right? Maybe there was a miscalculation of a or of an expense or a miscalculation of cost of goods sold or some miscalculation. This could be other adjustment. There could be adjustments due to change in accounting policies. There could be adjustments due to change in tax regulation. There could be a number of things in there. And again, uh, this is just, we are introducing the statement. So there are a lot more details in each one of these lines that we are not getting into yet.
The
Okay,
doctor, the adjustment can be added or and either added or subtracted. It
that is
means
correct.
we
That
can.
is correct.
Okay. What about doctor? Sorry. What about the repurchase of common stock? It means the common stocks are repurchased by stockholders from other stockholders.
No, if they repurchase, if you sell your stock to somebody else, it would not make a difference in the company's balance sheet. Repurchase of common stock means the company purchased the stock back.
But the company equity or capital is a number of shares already, stockholders, stocks.
This is not number of shareholders. This is the amount of money, right? This is the 729 million. So what would happen? Let's say I buy a share of stock from Best Buy, right? And uh, I paid 20 reals or $20. This would be recorded in the balance sheet. If I bought the stock from Best Buy, this would be recorded in the balance sheet of Best Buy at $20 and I have the stock. Now, if I sell you the stock, right, no matter how much you pay me to buy the stock, the only thing that Best Buy would do is have the change in name in that stock. So no longer I am the stockholder, you're the stockholder. That's the only thing they will change. It will not change any number on the financial statements. If I sold the stocks back to Best Buy, they gave me, let's say, $30 or $40 to buy back the stock, then that number would show up on the balance sheet. Do you follow?
Mhm. How 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 it is calculated the capital of the company, how it is shared? Is it shared between shareholders, stockholders, or the company as entity? It will preserve shares before uh, before uh, uh, before announcing the sale of shares in stock market.
Okay, now that that is a far more complicated discussion than just showing up the stocks here, because stocks have book value and they have the fair market value, and uh, itself, I mean, what the question that you're asking is a very advanced question, and we do not have enough background to go into this. But what we are looking at on this sheet of paper, on this document, is historical cost and the cost of repurchase. So when we say that 483 is the beginning balance, that means that is the amount the shareholders paid to buy the stock. Okay, this is what the company received from the shareholders when the shareholders purchased the stocks. This is another 303 million which the shareholders paid this year to purchase the stock. This is 729 million that the company paid the shareholders to buy back the stocks they had. So this is all that we have to understand for now from this sheet of paper.
Okay, last question, Doctor.
Go ahead.
The balance at Feb 27. What means exactly?
Balance
At February 27, 2010, or the balance at February 28, 29. What means exactly?
2009. So this is the amount of common stock that are outstanding, that are with shareholders. So until now, the company had collected $246 million by selling the stocks from the beginning until now. This is how much money the company received, minus if the company paid anything. So this is the amount of money that is with the shareholders in
And
stock.
what about the retaining earnings, the 4,397? It's
So
a
the
balance also?
this retained earnings comes from the income statement, right? The retained earnings comes from the income statement. So the earning is the accumulated earning from the beginning of the company until now. Revenue minus expenses equals net income. Net income gets added to retained earnings. So every time the company makes money, for example, this year the company made $1,317 million. This would get added to the retained earnings. So anytime the company has income, it increases the retained earnings. Anytime the company pays dividends, it reduces the retained earnings, right? So those two, right? Any income from the income statement increases, any dividends decrease, and then there could be other adjustments. You see, in this year, other adjustments are positive. In the following year, other adjustments are negative. And these other adjustments, there are books about what other adjustments could include, right? Not just chapters, but there are books and there are discussions, and there are, if you just type in other adjustments in Google Scholar, you will find maybe in excess of 100,000 research studies related to these other adjustments, right? So it includes many, many things, and we are at a very introductory level where we are not getting into these details yet. And some of these details will come in subsequent chapters, inshallah.
Okay, thank you, Doctor. Thank you.
Okay, no problem.
Thank you.
Anybody else? All good questions. Yes, Ms. Mariam, go ahead.
Yeah, doctor, I just wanted to ask you about the same sheet. The dividends here and the preferred dividends for the earnings per share. What's the connection between the two? Are they the same or?
Okay, now if you just see dividends, right, then usually they mean common dividends, dividends to the common shareholders. Again, the common shareholders, the common preferred stocks are different types of stocks that are sold at different points in time for different needs of the company. Common stockholders are general stockholders uh, who have voting rights, and they get dividends when the company declares a dividend, chooses to give a dividend. There is no guarantee. However, in certain preferred stocks, when the stockholders buy, they buy the stocks at a certain price, and they're guaranteed a certain amount of dividends regardless of the uh, results of the operations, or whether the common stockholders will get any dividends or not. So think about the preferred stockholders as first class seats, right, which would have certain benefits. And the common stockholders, think about it, let's say, like the economy, the class, right?
Yeah, but what's showing up on the sheet there is dividends for the common stock only.
If it is not, yes, generally, if the dividends are not separated as preferred dividends and common dividends, it is understood that it is common dividends.
Okay, but then do we calculate earnings per share for common stock as well?
No, we don't. In earnings per share, if we do not have any preferred dividends, like we did not in the calculation, we put 0 in there, you see.
Yeah.
So if we do not have preferred dividends, right, here it explicitly says preferred dividends. But if there is no line that says preferred dividends, and you have just dividends, then you would consider that common dividends, and you would not put that number in here. It would be 0.
So it would be 0.
Right. Yes, Mr. Muhammad.
Thank
Doctor,
you.
more precisely, if in case there is preferred dividends, so we'll calculate the earning per common share. If there is no preferred dividends, so the title will be earning per share. Simple.
No, earnings per share is always calculated using the common shares. The earning per share does not take into consideration preferred shares. So you see average common share outstanding. That's the formula. The earnings per share is always calculated for the common shareholders.
So there is as well as preferred dividends, there is preferred shares. Correct, Doctor?
Say that again. Like preferred dividends, you have common dividends. That's what you want to say.
No, we have common dividends for common shares, and we have
That's right.
also common preferred shares for preferred dividends. Correct.
No, the preferred dividends are paid to preferred stocks, right? So we have common stocks and we have preferred stocks. The reason we take out the preferred dividends from the net income is because this has to be paid. You follow? This must be paid because this is a guarantee for the preferred stockholders.
So it should be deducted in all cases.
What do you mean?
It means if we deducted the preferred dividends, it's mandatory that we divide by
You mean the common
common
dividends
shares.
also should be deducted?
No, we will divide by common shares. If we don't deduct it, we can generally get an earning per share. So we don't calculate only common share down. We can the total number of shares.
No, this is not something that you and I decide. The earnings per share is by default calculated for common shares.
Okay, understood now, Doctor.
Share is calculated for common shares. The reason, right, we do not just take the net income and divide that with common shares is because these preferred dividends, think of it as a tax, right? That is on the net income that you must pay out before the common shareholders can enjoy the income. So these preferred dividends are paid out, right, to the the preferred stockholders before calculating the earnings per share for the common stockholders, because the company in most cases do not have a choice to pay or withhold the preferred dividends. It has to be paid, and the common stockholders. Let's think about it this way. Let's say you're in an airplane and you have the first class and you have the economy class. Now there are 500 boxes of food, and the first class passengers each must get one box. Whatever is left, it will be divided into the economy class. So you have to take out the number of boxes that are going to be given to the first class, and then whatever is left, you divide that in the economy class, right? So this number of boxes that are going to be given in the first class is the preferred dividend. No matter what, you have to give each one box, and then it is possible that 2 or 3 people in the economy class sharing one box, right? After the payment of the preferred dividends, whatever is left is divided in the common shareholder. Do you follow?
So then the net income is the number of boxes. The common share is
The
number
net
of
income is the number of
passengers.
boxes, right? The preferred dividend is the number of boxes that you must give the first class.
But there is no first class passengers.
No,
Down.
there is first
No,
class
down.
passengers. Oh, in this case, yes. In this case, not necessarily first class passengers, but they are not promised any boxes right now. So the boxes are all going to be given to the economy class. You follow? So
Okay.
this is not a time for their meal. So this is not something that they will get right now. You follow?
Okay. Yes. Okay.
Right?
Thank you, Doctor. Thank you.
No problem. Miss
Okay, I
Allah?
got it.
Doctor, the preferred dividends, can we say that they are the one who are having the bonds and the common shares they having the stocks? Because I know that the one who have no, because I know that the company have to pay for the shareholders who own bonds first, then after they can pay for the shareholders who have stocks.
No. Bondholders are a separate class.
Oh.
Bondholders are a separate class. Bondholders are lenders. They are not owners of the company. Stockholders are owners of the company. They have a portion of the ownership of the company. Bondholders are just lenders. They give money and then they will get their entire money back, and in the meantime they get interest payment, right?
Okay.
Okay, that's a different category. All right, other questions? Okay, very good. So this is what we have in this chapter. Inshallah, I have posted practice questions and answers. Solve them, inshallah. And if you have any questions, you can email me, and I will see you, inshallah, face next week, inshallah.
Inshallah. Thank you, Doctor.
Inshallah.
Thank you.
Thank you, Doctor.
Thank you. Assalamu alaikum wa rahmatullah.
So.